Oh, nice. People are responding. Perfect. All right, I'm going to try to go through this. I have no clue how this works. Let's see if we can get the slides up here. So what I'm going to talk about today is digitization of assets. I run a investment firm along with two other partners. Our core investment thesis is that every stock, bond, currency, and commodity will be digitized in the future. I'm going to spend some time today talking about what that means and why it's important. The first thing is this shit is really hard to talk about. There's a lot of complexity. There's a lot of people who are focused on kind of the shiny, sexy new thing. The beauty of our business is we actually avoid anything that is shiny and sexy. What we're looking for are things that merely improve the old world. Whenever a new piece of technology is created, you can either build things the world's never seen before, or you can improve something that already exists. We're focused on the latter and let others go and focus on the shiny, sexy stuff. So our primary thesis, you need digitized assets, stocks, bonds, currencies, and commodities to unlock the true promise of automation. What does that mean? As we move towards a machine-to-machine transaction world and an automated world, they can't use the legacy assets. And so automation, there's probably nobody in this room that will argue with me that automation is coming. It's coming very, very rapidly. If you look at everything from manufacturing to other industries, automation every single year, year in and year out, continues to become more prevalent. Now, what does that mean? Well, it doesn't mean anything different than what we've already seen in the past. There have been many technology shifts in the past that have caused significant inflection points in different industries, and many firms that exist today have navigated those. If you look in the financial services business, I always talk about Goldman Sachs. They've been around for about 130 years. They pretty much have navigated every technology innovation that's occurred in that 130-year period. So change is not bad for those that can adapt and move with the change. Now, when it comes to assets, there's essentially three phases of assets. We started out with the analog age of assets, or the analog world. Every single asset was physical pre-1980, 1990. So you had physical cash, you had physical stock certificates, you had physical mortgages, physical deeds, etc. And those assets were able to be transacted, but only with those people who were within close proximity to yourself. So if I wanted to hand you physical cash, you could then hand me your physical mortgage. Or I could call up somebody on the stock exchange floor. They would then run over, and in an open outcry method, they could buy a physical stock certificate in a bid-ask model. But if we wanted to decrease the friction in transacting of stocks, bonds, currencies, and commodities, we couldn't continue to use physical assets in that analog age of assets. We had to build something new. And that was the transition to the electronic world. If you think of that electronic world, essentially what happened is we built electronic QSIPs. They're alphanumeric strings that are claims on those assets. And so again, those physical assets that thrived in the analog world, they didn't disappear. They're still there, but what we did was we created more efficiency in the electronic world. That electronic world today, when you buy an Apple stock, you're actually not buying the stock certificate. What you're doing is you're buying an electronic QSIP that is a claim on the Apple stock that sits within DTCC, etc. So by creating these electronic claims on the assets, we were able to drastically increase efficiencies, decrease friction, and open up to a more global transactions and more global world. Really, really important because there was a massive inflection point in the financial system, in transactions, and ultimately in GDP, commerce, etc. So we're on the verge of the same thing happening again with new technology. So we've seen this transition before, and the people who were early to that were able to create a lot of value and capture a lot of that value. But it's about to happen again. And we're moving to a fully digital world. Now, what exactly does that mean? That simply means that we're no longer going to have the physical assets or the electronic assets. We're going to have digitally native assets. These digitally native assets are really important because they all operate within one society. In the analog world, we all live in a country. We live in the United States. We happen to be in the state of Ohio today. But in the internet or the digital world, we all live in one world. If I get on the internet in Ohio or in the US and somebody else gets on the internet in London, we don't know the difference because we can actually transact with each other in that world. Usually it's been information, now it will be value. So what do we need in the digitally native world or for these digital assets? We need three things. We need digitally native assets, we need digitally native accounting, and we need digitally native contracts. This is really, really important. There's three key components to this whole thing: digitally native assets, digitally native accounting, and digitally native contracts. Now, why do we need digitally native assets? Well, the machines can't use legacy assets. Have you ever tried to put physical cash into your computer? It doesn't work. They can't use physical assets. They can't take a physical stock certificate. They can't take physical cash. They can't take a physical mortgage, et cetera. The same thing is true of the electronic assets. In a fully automated world, if I want to send something instantaneously in an automated fashion, I can't use assets that take 1, 2, 3 days to settle, right? Everyone's heard the example of, oh, we're not going to have to stop your car on a freeway and pay a toll by handing somebody cash. Like, newsflash, it's 2019. That's, something that's going to be in the past. But in order for us to be able to drive our car through a sensor and actually pay instantaneously, we're not going to be able to use existing assets. We have to have digital assets. And so the machines that can't use legacy assets are going to need these digitally native assets to be able to unlock the true potential of automation. Now, historically, digital assets have existed. If you think of a music file, it's a digital asset. And I could take that digital asset, and if somebody said, send it to me, I simply hit a button that says send on my computer, and what in the background happens is that computer file is copied, and one of the files is sent to the receiver, and I keep one of the files. Now, in the music world, it's not a big deal whether I keep the original or the copy, and whether you receive the original or the copy. And the reason why it doesn't matter is because you can hear the song, and I can listen to the song, and we're both happy. But the problem is, if that digital asset was a financial instrument or a financial asset, now all of a sudden I didn't send you a duplicate of the song, I sent you a counterfeit currency, commodity, stock, or a bond. So it becomes really important that you can't duplicate those digital assets. And so before the invention of a blockchain, you had to have digital assets that were non-financial instruments. Once a blockchain came around, now we can unlock these digital assets being financial instruments. So this is triple entry accounting or digitally native accounting. Single entry accounting existed until about 1300 AD. At that time, the Medicis popularized double entry accounting. Pretty much every financial transaction or any transaction you do in your life is built on double entry accounting. Double entry accounting requires the trust and belief in a centralized third party. If I send you money in the financial system, we're trusting that a bank is actually going to sign off on the debits and credits that are used in that transaction. How many people in here trust the banks and other financial organizations? Not too many hands went up. Why? Because trust is eroding in society, because they've done bad shit for a really, really long time and we stop believing their bullshit. So what happens when we get rid of that third party? Well, you have to use triple entry accounting. Triple entry accounting has actually been around for a really long time. 1989, a Japanese researcher came up with triple entry accounting, published a white paper, 0 people cared. Literally, he died and no one even noticed. 2005, a Google researcher came out with a white paper that said, well, I think triple entry accounting is really interesting, especially if we combine the triple entry accounting model with digital receipts from cryptography. Again, not that many people cared. 2008, somebody came out with a white paper that said, well, here's Bitcoin. Here's an application of triple entry accounting and digital receipts in cryptography. I think that this can be a really important thing. Bam, next thing you know, we've got a multi-$100 billion industry built on triple entry accounting. This is probably going to go down as one of the best inventions of our lifetime, and no one's talking about it. It's because most people don't realize that they're using double entry accounting, and they don't have the historical context to understand how important double entry accounting has been over the last hundreds of years. Moving into the future of an automated world, triple entry accounting will be the most important mechanism that we will use, and it will permeate itself through various technologies, blockchain being one of them. So you need digitally native assets, you need digitally native accounting, and a blockchain is simply triple entry accounting in an automated fashion. You and I cannot keep track of how fast the machines can transact with each other. We need to have something that does it in an automated fashion. A blockchain does that. And so once we have those digitally native assets and the digitally native accounting systems, we need digitally native contracts. Essentially, how do we enforce the rules of the agreements that we have with these digitally native assets and accounting? Smart contracts. And so smart contracts are simply enforceable contracts for machines. Literally, the machines are now going to be able to transact with each other. They don't have to call a lawyer and say, what's the contract say? They simply execute what we tell them to execute, and it's done in a way where, 1, we know what we're entering into, 2, it's transparent what's happening, and 3, it's enforceable in a court of law. So once you go ahead and you get digitally native assets, digitally native accounting, and digitally native contracts, you now can absolutely unlock the true potential of automation. So you don't have to take my word for it. Every major corporation and great entrepreneur that runs a large company is working on this. Mark Zuckerberg's working on it with Libra. Blythe Masters is an advisor to a company we'll talk about in a second. Jeff Bezos with their blockchain business in AWS. Jack Dorsey, obviously, with Square. You've got Abigail Johnson, who says this is one of the most important areas that they're working on at Fidelity. And then, obviously, Jamie Dimon, who hates Bitcoin but is a big blockchain fan, also then somehow came up magically with JPM coin, which is going to replace the dollar. We'll get into that as well. But it's not only the large corporations that are doing this. Also, lots of challenges are entering. The smartest entrepreneurs and the smartest investors in the world are throwing tons of intellectual and financial capital at this market. Why? Because it's a really, really big deal. So now that we're seeing the companies building in the space, where do we see the opportunities? For us, we really focus a lot on infrastructure. We think that those who help to facilitate the transaction or the transition from the electronic world to the digital world will end up creating incredible value. I'll give you two examples. After I go through these examples, we're going to do some questions. So if you want, there's some people with microphones. First example is a company, Figure. We just announced last week we did a $100 million Series C that we led in the business. In a traditional home equity line of credit, there's a borrower and a lender. In between that borrower and lender, there's 5 to 6 middlemen that charge a combined 7 to 8% fees. In that process, there's a long list of companies who have tried to automate mortgage origination. They all fail for the same reason. You can write software to automate away a lot of those middlemen, whether it's underwriting, custody, etc., but you cannot have an automated system with physical assets or electronic assets, right? Physical mortgages or electronic mortgages. So somebody either went into a bank and signed a mortgage and it sits in a filing cabinet somewhere, or you have electronic QSIPs that take 2 to 3 days to settle. If I want to create a digital mortgage, I may be able to disrupt that. That's what Figure's done. They set up a website, figure.com. You can go. They will tell you within 5 minutes of you submitting the application whether you're going to get the HELOC or not, and they will fund it within 5 days. Now, a traditional HELOC takes 45 to 60 days. This business will vet, approve, and fund a home equity line of credit within 5 days. Super disruptive to the marketplace. They've gone from non-existent to today they are, in less than 2 years, become the 4th largest HELOC originator in the country. None of that has to do with a blockchain. All they are doing is simply getting better access to data and using that data to better underwrite in a more accurate, real-time way because they now have the technologies that are available, whether that's machine learning, artificial intelligence, data modeling, etc. But in this business, what does every mortgage originator do? They take those mortgages off their balance sheet and they sell them on the back end through the DTCC to another counterparty on Wall Street. They're literally selling the paper on the back end. When you go to do that, the problem is that Figure has a digital mortgage. It's literally a computer file that has all of the information that you would traditionally have in the paper folder in that filing cabinet, now in a digital format. Well, DTC's technology is built to settle electronic QSIP transactions. They have a digital mortgage. It's like trying to take a CD-ROM and jam it into a cassette tape player. It just doesn't work. It's incompatible technology. They had to rebuild something that looks like DTCC. They call it Provenence. It's a blockchain-based settlement system that is overseen and governed by 12 separate node operators. Those node operators include folks like Franklin Templeton, Experian, et cetera. And then what they've been able to do is go out and solicit some of the largest companies on Wall Street to come in and actually start to buy their assets through the Provenance system rather than through DTCC. So if you're a large Wall Street bank, why would you buy a digital mortgage rather than an electronic mortgage? Well, first of all, you actually can settle the transaction through Provenance same day. So in the traditional system, it takes 2 to 3 days to settle. Here, I can do it same day. That means my capital is at risk for less time. There's a material cost savings that comes along with doing this in a digital instantaneous format. And the last piece is because there's a digital mortgage, now all of a sudden the rating agencies can more accurately rate the debt because they have access to better information, more real-time information. In the traditional world, those rating agencies have to be overly conservative in their ratings because there's a latency of information. They have to wait 30, 60, or 90 days to get updates on how things are performing. Here, they have more real-time data, they can be more accurate, and so therefore they don't have to be overly conservative, which is likely to lead to higher ratings on the debt as well. Now, this business has gone from non-existent to the 4th largest HELOC originator in the country. They've done about $1 billion in loans. They have been so disruptive that they've now publicly announced competitors of theirs are coming to them and saying, we can't compete with you. We don't have the technical capabilities internally to do this. We would like to license your software. And so what you will start to see is, again, every stock, bond, currency, commodity will eventually be digitized. This is a great example of simply taking home equity lines of credit, using a new origination model that takes data, machine learning, and access to information, better underwrites faster in a more accurate way, and then allows for the transacting of it in a fully compliant, regulated way, but drastically reduces the friction in that back-end transaction model. So Figure's one example of that. The second is a company called BlockFi. Everyone knows how a consumer bank works. You simply deposit fiat currency. That fiat currency then, banks will spend a lot of money to get you to deposit that fiat currency. Why? Because their entire model is built on selling you the financial services around your deposit, right? Bank of America, et cetera. And so what BlockFi basically has done is said, well, I bet you people want to deposit digital currencies rather than fiat currencies, and then we will go ahead and offer products around that. The first product was a lending product, so you deposit Bitcoin or Ether. They go ahead and give you a US dollar loan against your collateral. The second product is an interest-bearing account. So they do exactly what your bank does. When you deposit your money, newsflash, it's not your money anymore. A lot of people think that when you have money in a bank, it's your money. It is not your money. They owe you the money, but it's now their money. They take your money and they do whatever they want with it, and they pay you next to nothing for doing it. So we're probably the suckers in that model. But what BlockFi basically does is they take the deposits, they go ahead and they lend it on the back end, they earn interest, they pay very high rates of return currently for that, as much as 6.2% APY on Bitcoin. On a digital dollar model, they pay as high as 8.6% APY. So what we've gone around the country talking to folks about, especially in the institutional world, is the people who are earliest to understanding how to buy, hold, and invest in these digitally native assets, these digitally native stocks, bonds, currencies, and commodities, will have a significant advantage from a return perspective compared to those who are still operating in the analog or electronic world. The best example I have for you is you can go ahead and take a large amount of money, put it into a money market fund in the fiat world or the electronic world, and you can earn anywhere between negative 0.5% up to about 1.5%. So 150 basis points to negative 50 basis points, depending on where you are in the world. If you take that same money and you put it into a GUSD deposit account with BlockFi, it's simply a digital dollar. You put fiat into an account with State Street. Through State Street and Gemini, they issue a digital dollar. You take that digital dollar, you go ahead and you deposit it into BlockFi. They pay you interest. That interest rate is 8.6% APY currently. 150 basis points on the high end in the fiat world. In this world, it's 8.6%. Why is there a difference? It's supply and demand. How many people have deposits at traditional banks in the electronic world? Everybody. There's only so many people who want to borrow. In the digital world, there's a ton of people who want to borrow because it's more efficient to transact the digital dollars around the world than it is the electronic dollars. The problem is there's not a lot of deposits yet. And so as more and more people deposit, obviously those rates will come down and be commoditized. But the people who are early to understanding where these arbitrage opportunities exist and understand that eventually every single stock, bond, currency, commodity will be digitized will be rewarded. And so that's what we've done with our institutions is we've got the only 2 public pensions in the United States that are currently invested in blockchain or cryptocurrency fund. We've got a hospital system and a bunch of others. And what they're looking for is trying to understand how are assets, the base unit of account in each one of these markets, going to change. And when they change, what does that do in terms of how we buy, sell, or hold these assets in our portfolio? So our belief is that your portfolio will look exactly the same. You'll have the same asset allocation. You'll actually transact with the same counterparty. You'll own the same asset. You'll just simply buy it in a new technology form factor. Before we start taking questions, the way that I describe that is imagine being one of the first people to realize, rather than call up my broker on the stock exchange floor and have them run over and do bid and ask in an open outcry method, what if I could just simply log into a computer and execute the same trade? I'd have better access to information. I have better trade execution, and I could actually probably get different prices from different counterparties. And so the people who are early to understanding, wow, I'm going to execute the trade through the computer rather than call the broker on the floor, simply had an advantage. That's essentially what's happening here, but rather than it be computer versus human, now what we're seeing is automation versus the traditional system. And so that's where we think the big opportunity lies. All right. I went through as fast as I possibly could. We've got 9 minutes and 45 seconds, then I got to go to the airport. What questions do you guys have? Oh, there's don't get me yelled at. They've got, go ahead. I can't see, so just yell.
Okay, now, if I'm an investor, will Schwab, like now they've cut out the brokerage fees.
Yep.
Now, will they offer me a chance, or how would they do this? Would it all go digital, or would they have digital and regular?
Yeah, so eventually they're going to have to, right? If you look at Fidelity, for example, Fidelity's got quite a big team, Fidelity Digital Assets, that's working on this, and their belief is that as every stock, bond, currency, commodity gets digitized, most young people don't use the legacy assets or markets. So I've got a brother who's 23 years old, and a couple of weeks ago, I jokingly asked him, I said, hey man, you know how to send a wire? You know what he said back to me? He goes, what's a wire? And I said, what do you mean? I said, how do you send money to people? And he goes, well, I send money to people two ways. I either Venmo them or I split my Uber ride with them. I said, all right, man, I never thought about it that way, right? But when you think of it that way, it's people who are of a younger demographic. They grew up with a cell phone in their hand. They're digitally native people, and so they want to use assets that are digitally native as well, and they have certain demands, and that's what we're seeing. So if Charles Schwab or Fidelity, et cetera, want to keep those customers and get the folks who are growing into that demographic, they're going to have to interact with these digital assets, and we see some of the most forward-thinking folks doing that.
Now, they would only do that if, okay, I should be offered, if it's cheaper, or would the price of the stock be cheaper, or what would be cheaper, or what would be easier?
So it's not so much the asset price itself changes, it's more the transaction fee. So stocks aren't necessarily super expensive to buy because they're all going to zero fees anyways. But again, if you go back to that HELOC process, in the origination and servicing, there's 130 basis points of savings that Figure has realized. And so 130 basis points to an individual who's investing hundreds or thousands of dollars doesn't sound like a lot. But when you're a very large financial organization and you're looking at 130 basis points of savings, and you're investing hundreds of millions, if not billions of dollars, it ends up being very, very material savings. And so I think it's all kind of specific to the asset and the market that you're talking about. But at the end of the day, what automation does is it strips out middlemen, strips out bureaucracy. And so a blockchain is just an automated trip-on-tree accounting system that we think can go ahead and create a lot more efficiency in the marketplace. Just yell.
Did you have a question?
No? Who else? Go ahead, just yell, I'll repeat it.
What are the risks of purely digital assets, like securities market and so forth?
Yeah, I actually argue the opposite, which is what are the risks of the traditional world, right? And the reason why I ask that is if you go ask the head of structured finance at Jefferies, he's incentivizing folks to originate on these blockchains. Why? Because it's cheaper and more efficient for him and his organization to keep track of those that they've given the lending facilities to. And on top of that, in the worst case scenario, let's say one of those originators gets blown up, right? They go out of business. There's a bunch of problems today with going and finding what do we actually own, where's all the paperwork, kind of all the problems in asset-backed securities. Well, now if it's all on chain, we know exactly where it is, and so it's much easier to find. That's kind of the private corporation value proposition, so it makes a lot of sense for them to do it. The other piece of this is the regulators. So we came out last year and we said, I actually think that the SEC is going to mandate that every single stock in the public market gets digitized or tokenized in the future. So there's precedent for this. In the early 90s, they mandated the use of Edgar. You had to report the information in so that everyone had access to the same information. Then in the mid-2000s, they mandated XML. The data that you reported had to be readable by machines. So again, people had access to that information. What digitizing those stocks does is today regulators are very reactive. So if you and I do something and it ends up breaking the rules, they spend a lot of time, money, and resources understanding who we are, what we did, building a case, and then enforcing on us, right? But if everything is digitized in this model, what they can do is they can write the law into the code. And now if I go to transact, let's say a Reg D security, I'm an accredited investor, you're not, I go to transact that with you, they can actually preemptively stop that transaction. They can recognize in real time this is a non-compliant trade, and they can stop us from ever breaking it. What that does is it saves them a lot of time, money, and resources on the back end from having to go enforce on us, right? So they can create a much more regulated, safe marketplace by going to this digital model because there's more transparency, there's more access to information, et cetera. And so we actually look at the old world and say there's much more risk in the old world compared to this new world because of some of these advantages of a transparent blockchain.
Are
Yep.
you seeing
Yeah, so think if you're a large Wall Street bank, if I tell you, hey, I've got a way to do faster transactions cheaper and you'll get higher ratings on the debt, you're probably pretty interested, right? And the reason all of that is possible is one, you're stripping out middlemen with blockchain and the automation stuff, and then two, again, is it's access to information. So a lot of this, people are very focused on like speeds of transactions and all that kind of stuff, and there's advantages there. For me, the access to information is really important. And so if you have a electronic QSIP-based asset that takes 1 to 3 days to settle, and you're only getting information updated, let's say every 30, 60, or 90 days, you only have the information you have available to you. But if all of a sudden you go to a model where now I have near real-time information and performance of this loan, then I'm able to transact it in a much more instantaneous manner. I just have better execution, and I also have better access to information. Of course, I'm interested in having more information, more advantage, et cetera. And so that's where we see a lot of people moving over, is people who are just saying, like, look, I like information. I like to have the real-time nature. I'd much prefer that over waiting 30, 60, 90 days for performance reports.
So you said earlier that the information is easy to find. So let's say I transaction 3,000 out of like 150,000. That's a lot of transactions. So how would you go about finding that information easily? That's a lot of information compacted.
The beauty is the computer's smarter than us, right? So I'm not going to go find it. You're not going to go find it. But if I ask a computer to find it, they'll find it before you blink. And so that's the beauty of all of this automation, is that we no longer have to rely on you or I, right? We get to rely on the computer. Now, the computer was built by humans. The software was coded by humans. So there's some human element, and there could be human error in that. But what we're starting to find is that in a lot of these systems, the computers are actually better at detecting fraud. They're better at detecting errors. They're better at detecting things that are going wrong or kind of the edge cases than humans are. And so if you go to a perfect example would be, how does Figure do that underwriting, right? So they do it in 5 minutes. Well, if I want to apply for a HELOC, what do I need to do? Employment verification, bank relationship verification, income verification are 3 pieces of that. Historically, I submit a bank statement, I submit a letter from my employer, and I submit a pay stub. If you are the originator, you take that information in, a human looks at that information and actually usually calls your employer, your bank, et cetera, and verifies the information. Well, in the Figure process, all you do is you take your username and password and you log into your bank account, right, through like Plaid. When you do that, well, you just logged in, so you're definitely a customer because you have a username and password. Then I can quickly scan using automated technology to see who's direct depositing every 2 weeks into your bank, and then I can see the exact amount that they're depositing. So I just did bank verification, employment verification, and income verification. And I'm probably actually more accurate in the very few cases where people doctor the documents or I don't follow up and actually call. The machine is able to get better access to information quicker, and so can make decisions that are more accurate and faster. And so that's the type of stuff where we really see a lot of advantages, is unleashing the power of the machines in this digital world, because the machines are just better than us at doing pretty much anything we want to do computationally.
What were your biggest learnings and some of the biggest surprises?
His question was, what are my biggest learnings from having spent the last couple of years investing? One, backing the best people is the secret, so it's not really a secret. The biggest investing mistakes we've ever made are when we fall in love with an idea or fall in love with a market, but we back a team that maybe we're not as excited about. We've never gone wrong when we've backed a team that we really believed in. I would say is one big piece. A second piece is the best entrepreneurs don't need that much help. I think there's a lot of folks who run around and say, hey, I can be a value-add investor, et cetera. But the best entrepreneurs, they know what they're doing. They need some capital, and they might need some advice here and there, but for the most part, they don't need that much help. And then the last thing I would say is the key to building a very successful business is so simple that people overlook it. It's simply just building things that people want. And I think a lot of times we get caught up in how much money can you raise or what market are you going after, et cetera. But if you find entrepreneurs who understand that you just have to build something that people want, you end up building really, really successful companies. And I think the largest companies in the world today, over the last 20, 30 years that have been built, they simply continue to build things that people wanted. And we look at it today and we're like, wow, Google is really valuable. Well, yeah, it's because we all use Google Maps every day. We use Google Search every day, right? It's things that we wanted, whether we knew it or not. And I think that's been one of the constant reminders in investing, is finding teams that understand that and embody that in the work that they do. Do what? Yeah, see if I like my podcast or investing. The podcast doesn't work, man. I'll shoot the shit with anybody, so that's a lot of fun. All right, guys, I'm out of time. Thanks so much for coming, and hope to see you guys next year.